Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
It feels like a quiet Monday, and the asset that's moving is definitely going to be Bitcoin and all the crypto-related stocks. So we've got to go to Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. Not to mention that gold's a little softer at the moment, but that's also still at a record for reasons. It's really hard, I think, to pinpoint that reason for it. Hey, Mike, first of all, I'll start with Bitcoin here. What if you say halving? I mean, come on now. What else is leading this rally?
So it's mostly ETF inflows, Alex. It was about, I think it was January 10th that they were first launched in this country. There was almost a dozen of them. And the inflows have been shockingly strong. So I just looked in the numbers on the terminal. Right now, the total amount tracking Bitcoin and ETF now is about $70 billion. I compare that to gold, which is stuck around $184 billion. It's about 40%. So massive inflows, and the cut in supply basically around tax day. It's a pretty significant sweet spot for Bitcoin. But what I find most significant lately is the fact that Bitcoin is showing divergent strength versus beta, with the S&P 500 down this morning.
Yeah, I guess one thing about Bitcoin, though, is a question about volume. We've got a supply shortage, and yet there's tens of billions of dollars trading every day. How do you square these two things?
Well, it's not so much a supply shortage, I guess. It's just you can see it coming down. It's something that it's the high price cure that affects all commodities with the exception of gold. You don't have that supply coming on with higher prices. But I love when you mention volume, because I love clicking on coinmarketcap.com and checking volume. And the volume of Tether, the number one traded token, of which is the U.S. dollar, is basically double Bitcoin on a 24-hour basis. And its market cap's up to 102 billion now. So it's one thing that a lot of people don't know in the space is Bitcoin is speculative. Yes, it's a replacement for gold. It's a digital version. But in this space, the most widely traded asset is the dollar.
When you look at, say, the offshoots of crypto, like the stocks, the exchanges, the miners, etc., are they trading as well as the underlying asset?
Yes. Well, I guess we have to mention MicroStrategy. We've all heard Michael Saylor. I just saw him on a few other programs recently. On a one-year basis, MicroStrategy is up almost 600% compared to Bitcoin, up 230%. And the significance of him is he's been buying Bitcoin. He's one of the sages that really got me somewhat bullish a few years ago when he's pointing out the history. And he says, hey, the world's going digital. This is potentially a replacement of the dollar, not so much the dollar, but of gold. And he's been converting a lot of MicroStrategy's strategy to buying Bitcoin rather than doing other things in technology.
I guess, but if you go back to your point that we started out with on the ETF flows, I mean, who are the winners and losers here amongst the ETF providers? I mean, is this still a BlackRock versus everyone else story, or is there something more interesting to think about there?
The biggest winner is Grayscale. They're the ones, so we've got to remember, they kind of tilted this over. Michael Schoenstein of Grayscale was the one who initiated the litigation with the SEC, and he took a major risk. I call it profiles and courage, and he won. So right now, Grayscale, the GBTC, the Grayscale Bitcoin Trust, is about 28 billion, and the next is the iShares Bitcoin Trust, about 13 billion. But the thing about iShares Bitcoin Trust is that didn't exist just a few months ago, and Grayscale was higher. So a lot of that money is migrated, but now it's just net inflows. And I think it's at the stage we're hearing this from professional money managers are tilting that way. And that's what really struck me when I went to the ETF conference about a month ago in Miami. Eric Balchunas moderated panel, and there was so much interest from these, I'd say professional money managers in Bitcoin.
Well, that's my question. If all of a sudden Bitcoin, for whatever reason, sort of tanks 20,000, right? It's super volatile asset, right? Like no one's pretending that it's not. Do those people that want a 1% allocation in their portfolio to Bitcoin care? Or is this now a long buy and hold strategy with some traders trading around the volatility?
Well, obviously, it's the number one traded, I like to call it the number one traded asset on the planet, 24/7, number one leading indicator, Alex. But I think what's happening now is we're in the early days of the institutional, the RIAs, pension funds, endowments getting allocated to this space. They're starting with 1%. Yeah, of course they care, but the back tests look too good, unfortunately. I like to pair it with gold. And I think it's one of those spaces, it's either way it goes, it's just the early days of those inflows. What thing really shocked me was I didn't think there would be that much interest in these ETFs, and you just got to follow the money. It's very strong inflows.
Yeah, as you say, it's early days for this ETF strategy. And how do you compare this to the birth of other ETFs markets? Like, what can we expect? Can we expect a whole lot more players, or is it all going to get weeded out very quickly?
That's the thing. It's broken all the records compared to GLD or even SPY, their early days. It's broken all the records. It's basically the benchmark now for and I don't think we'll ever be able to match it. The thing is, I compare it somewhat to Tesla. Tesla spends nothing on advertising. They don't have to because everybody loves Tesla. Bitcoin is the same way. There's nothing to advertise it, but it's so in your face. It's one of those things I put on my DI list. I try to deliberately ignore it, but I can't because you just hear about it and read about it everywhere. So that to me is what's happening. It's just that significant of an asset at the moment. And at some point, yes, it should have a good correction. The key thing that's been bothering me is we've had basically straight up in the S&P 500 since that low in October, no correction. The most significant correction was the first week of the year is 1.5%. But we've had good corrections in gold, which founded a good foundation. We've had good corrections in Bitcoin, which formed a good foundation. Flushes out the week longs. We haven't had that in the stock market. And that's what I'm afraid we're way overdue for. Just a normal 10% correction, like used to happen. How does Bitcoin respond in that space? And I think what's happening now, sure, it should go down, but we think the responsive buyers will be greater in Bitcoin.
So basically it's going to go down less. This is totally the classic gold argument too. Like when everything goes down, so does gold, but it goes down less. Bitcoin the same then.
Yes, well, it did initially in 2008, but the difference with gold now is it's basically been unchanged for 3 years. It's had that time correction. It's had that little correction this year down to 2000, and that's the difference with the S&P 500. I love watching the E-mini weeklies. I used to trade them. There's a gap in the E-mini weeklies from last year when we broke out on the Powell pivot. It's about 10% below the market. We've never left a gap in the S&P minis since trading in 1997 on a weekly basis. So that kind of stuff concerns me.
Okay, one last question for you, if you don't mind. For Bitcoin,
he minds. He doesn't like talking about Bitcoin at all.
No. I think I'll
He's
just
like,
throw this
whatever,
one in.
I want to get out of here. Back to the sun.
If we do see an S&P correction anytime this year, what do you think the margin is going to be like between the Bitcoin correction and the S&P correction?
Typically, Bitcoin trades with about a 3x beta or 3x volatility. If it's S&P corrects 10%, Bitcoin goes down 30%. But what it's showing right now is divergent strength, as you see it today. S&P 500 is down, Bitcoin's up. So if it was put this way, a successful divergent strength would say if the S&P 500 corrects 10% and Bitcoin corrects only 10 or 15%, that's a sign of divergent strength. Right now, stock market's going up and stock market's going down and Bitcoin's going up. Now that's somewhat unstoppable for money flows. If people see this as a diversifier, the horde will come, and that's what I'm afraid of.
Hey, Mike, really good perspective. Love that. You look a little tan. How's that sun there in Florida?
It's rough. I mean, the vitamin D is great. Keeps you healthy.
Mike McGlone, Paul Sweeney, always jealous that Mike went his way to Florida. Mike McGlone, he covers everything commodities research focused for Bloomberg Intelligence. I think that once I get positive on Bitcoin, then we probably have a problem.
Oh, that would definitely be a signal for myself. If I'm starting to look at it, that would mean sell.
That right? I mean, that's what I'm looking at. But it's going to be interesting, I think, just in terms of how much portfolios wind up allocating, right? Like, I remember this with gold. I mean, back in the day, if you have central banks reallocate by 1% extra, it would be a huge boon to gold prices. And you have to wonder, are we going to get 10% portfolio for people, or is it really just going to be 1%? And what that shift actually winds up looking like. But
that's the issue. It's like, where do central banks stand on the matter? And there's a lot of not unhappiness, but a lot of reluctance. I mean, Jay Powell last week said pretty firmly the Fed is not anywhere near there yet. So we're not going to have that dynamic anytime soon to worry about.
John Tucker, you got Bitcoin in that portfolio?
No, that's the one I don't have.
Do you have crypto stocks?
My philosophy is if you don't understand it, stay far, far away.
I know, but at some point we're going to look at it and be like, we got to get into that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, so markets, let's be honest, not doing that much. We're looking at that weakness in Meta that we were just talking about. We're kind of questioning if Bitcoin's going to keep rallying, if the NASDAQ doesn't really get any support here. And my big question, of course, throughout the whole 2 hours is I will find someone who has watched the Oscars and can talk with me about I'm Just Ken. Maybe this person will be Sarah Ponczek, financial advisor at UBS Private Wealth Management. Is it Sarah? Are you that person for me?
Alix, I'm so sorry to disappoint you, but no, I didn't watch the Oscars last night. But I have seen Barbie, but no, I didn't watch the Oscars.
This does not count. This does not count, Sarah. You just okay. All right. Well, this is actually going to be a thing. Will I find someone in the next hour and a half that has seen the Oscars and can talk about I'm Just Ken? In the meantime, Sarah, let's talk about the markets. What do you make of this?
The Oscars are more important now, right?
I mean, to them for sure. Particularly for Disney, they did really well.
They did, yeah.
They probably were very happy about that. Anyway, Sarah, NVIDIA losing a little bit of steam. It's flat right now. Meta kind of rolling over. What's your read on tech right now?
Right, so it's only natural that we are seeing some of these big tech names taking a breather. We can't see them continue to power higher and higher and higher at the rate at which we've seen over the past year, let's say. But with that said, we're still pretty optimistic on tech here. And there's a couple reasons for that. One, yes, AI has this massive buzzword. But when you look at the underlying fundamentals and you look at the amount of money that companies are spending on infrastructure spend, on technology to make sure that they are at the forefront of their AI game, we saw it in NVIDIA's earnings just a few weeks ago. There is actually truth to this. And our chief investment office actually estimates that AI revenues are going to grow 70% a year through 2027. So massive growth ahead. So there is reason that, and there are numbers, frankly, that are driving this rally. So we're still optimistic on tech. That doesn't mean that these 7 magnificent companies are your entire equity portfolio. But what it does mean is you want to make sure that you're not underexposed to tech. You don't want so much less tech in your portfolio than the benchmark per se, because the risk here is really missing out and being underexposed to what might be one of the greatest growth trends in the stock market over the next decade.
I want to push you a little bit on your point about companies continuing to spend and invest. I mean, what's your outlook for companies to continue to have strong power to do that? Because, what's the market thinking about now? They're thinking about the Fed meeting coming up next week and the prospects for a soft landing. If there is slowdown, then the read across to that for company spending would be reduced spending. So how do you put these two things together?
You're right. And we've seen that front and center over the past couple of years, especially in the technology space. We have seen some technology companies that for years, they've been known for having vast, expansive workforces go through a series of layoffs, and they have been doing cost cuts. But when you think about the overall economy, and not just the U.S. economy, but the global economy, and when companies are sitting in a room together and they're thinking about what is the most important thing for us to be spending our revenues on in the years ahead, the decade ahead, oftentimes, and we've heard this in earnings calls, it's artificial intelligence, because many companies know that, again, they can't risk falling behind. They don't want to risk their competitors surging ahead of them. So yes, you're absolutely right. We have seen companies cost cutting, and those that have been cost cutting have been rewarded for that. Mm-hmm. But when it comes to deciding where you want to spend your money, tech spend has still been very important.
So Sarah, if, though, we take a little bit of a breather in tech, do you think that there's enough of a powerful rotation into other areas of the market, aka some kind of value in cyclicals, to help support the overall index, or are we just going to see some level of softness overall?
So we have seen a broadening out, absolutely. We've seen a broadening out since late last year, and even more so this year, and we do expect that to continue. So to give you an idea, yes, we do like technology here, but a couple of other sectors we still like here are healthcare and industrials. A few reasons for that. One is healthcare can be seen as a more defensive area if you want to diversify your portfolio, but has also had a major boost from all of these obesity drugs that have just exploded in popularity. Industrials, that's more of a cyclical play. If we truly do see this Goldilocks economic scenario and a soft landing, which has come to be the base case, you would expect that more cyclical areas of the economy are going to start doing some of the heavy lifting. It's not going to be tech alone. So yes, even if we do see tech take a breather, look, we're probably not going to see the same returns that we saw last year in the S&P and the NASDAQ, but you could still see positive returns going forwards for equity markets as we start to see other sectors, other industries pull their weight as well.
What's the sector that you think is going to be suffering the most going ahead?
It's a great question. What I would say, certain areas of the market that we haven't been huge fans of lately have been utilities, real estate. Some of that was a yield play. With interest rates where they are, you don't really need to go find higher paying dividend stocks or bond proxies in the sense of utilities. But it's just not an area that we've favored so far.
What is your thought, though, on Bitcoin? Let's kind of end where we left off, which is the idea of, okay, you have this tech softness, Bitcoin's on a tear, and having tech be a teeny bit softer and Bitcoin doing really well is a bit of a head scratcher. So I'm wondering what you think about it.
Alix, I should have known coming into this that you would ask me about the Oscars and Bitcoin.
Yeah, you should have, Sarah. You really should have.
I should have known. This is what I would say. There really are still no fundamental drivers behind Bitcoin. Yes, there has been a massive rush to the space ever since the launch of Bitcoin ETFs. It's just made it much easier for investors to get a piece of it. I will say crypto is becoming, it is an asset class. It's not becoming, it is an asset class. And for many, it has become a small component of portfolios as a diversified, portfolio. But at the same time, before any investor is going to dip their toes into the Bitcoin market or the crypto market, especially at the levels we see Bitcoin trading at now, you have to look yourself in the mirror and ask yourself if you're okay and you're prepared and willing to tolerate the volatility that's going to come with. Because yes, it's been a straight shot up over the last year, but people have amnesia. Same thing with tech stocks too.
Yeah.
Everyone remembers 2023 in which tech ran up and Bitcoin ran up. But how did you feel in 2022 when you saw everything, taking a tank dive as well? So there's still a lot of unknowns surrounding what crypto is going to become, where Bitcoin really fits into our economy and the financial marketplace. So there's still going to be volatility. It's an asset class, but you have to be able to make sure that if you're going to invest in Bitcoin, you need to be able to withstand the volatility.
All right, Sarah, next time. You'll do better. All right, Sarah Ponczek, financial advisor at UBS Private Wealth Management. Great stuff joining us there. On the idea that you got to be cautious when you're buying Bitcoin. I love that. Can you look at yourself in the mirror and feel okay about it?
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go now to the news over the weekend, which was Reddit finally getting it together to launch its long-awaited IPO. Amy Orr, Bloomberg Equity Capital Markets reporter, joins us now. First, did you watch the Oscars?
No, I am alone.
I am alone, people, so far.
When did the ratings come out so we know how many people didn't watch the Oscars?
Me, my husband, and my daughter didn't watch the Oscars.
No, like Arbitron or whatever.
We will watch that and learn.
The Nielsen ratings.
Okay, now, John Tucker, your assignment right now. Go watch I'm Just Ken. Just watch it. Just watch it during this segment.
All
right, Amy. Fine.
I want to listen to Amy, though.
Reddit. Remind us what Reddit is, first of all.
It's a social platform, essentially, for people to talk about anything. And then it's kind of evolved into a place where you can find information about really deep dive into things. So a lot of guys would be chatting about running shoes and what model fits and how it fits and then how to break shoes in, that kind of thing. Mm-hmm. And many other more. And sometimes it's good, sometimes questionable. So it's a social platform for people to express their views and ideas.
I wonder if they must have an I'm Just Ken thread. There has to be.
Have to be.
Okay. You asked another question that's smart, and I'm going to go look that up. Okay.
So I guess, can you give us some context for the Reddit IPO? What's the size that's being projected? And then how does this fit in with how the market is developing so far this year? Because last year it was not such a good IPO market, was it?
Yeah, it wasn't. And it's still, the IPO market is still rather subdued so far this year. There were only about $7 billion raised, but there were 5 IPOs raising more than $500 million, which is decent. But compared to 2021, when Reddit actually filed confidentially for an IPO, that was an all-time high. That was more than $330 billion raised. And then so like in the grand scheme of things, we're definitely not there and might not even see that ever again. And then at that time when Reddit actually filed for an IPO, it was valued at $10 billion. Right now at $31 to $34 price range per share. It's like if it's priced at the upper end of the range, it's going to be $6.4 billion in terms of valuation.
Oh, wow.
So it's still like a bit off from the $10 billion that it was projected to be back in a few years ago. So it's kind of missed the boat in terms of IPO sentiment. And so we're going to see whether it's going to be. So there's still a chance that they can price above the range, but we'll have a look.
Jen, you are right. There is a Reddit thread on I'm Just Ken. So I find at least somebody is with me on this one. Talk to me about how Reddit also got into the vernacular when it comes to the meme stock craze that we saw, right? I mean, that's when Reddit became super significant to Wall Street in a very particular way.
I think it was significant in a lot of people's hearts, like for the geeks, but it kind of like significant when people actually went on the theme where they can actually talk about stocks and to actually to assemble the amount of buying interest in a particular stock that actually drove the prices higher. And I think Reddit is trying to replicate that for its own IPO as well. They're giving 8% of the IPO to people who are really heavy users, moderators of Reddit threads. But then the funny thing, though, is for these 8% of the stocks, they do not have a lockup. So it would be very interesting to actually see whether they actually sell on the first day or during the first week, because at the end of the day, these are retail investors. Technically, a lot of the IPOs or issuers do not like retail investors because they're very sentimental, they're very emotional. If it's rise a lot and then on the first day and then people will sell. If it falls a lot, people will panic sell as well. So that's why most of the time people will allocate a lot more to institutions. The fact that they actually allocate 8%, I think they're trying to replicate that meme kind of craze, like for his own stock, but whether it works or not is a different story.
One crazy question, though, I would like to ask you. You might have no view on this, but I want to ask it anyway. We've got two very interesting internet plays in the news today. We've got Reddit, but then we also have TikTok. Do you see any way to put these two together in your head for an investor, for a user, for sentiment?
Well, it's really, at the end of the day, it's really about advertising and how much you can, and also how sticky in terms of the users, right? Definitely, a lot of the Reddit users are actually very sticky. But then it's also most of well, not most, but half of the users for Reddit do not actually have a login or do not actually see most of the ads. And then so whether it can actually turn that into ad revenue, it's a different story. But then Reddit now is trying to license some of the geeky kind of links and threads in order to generate revenue for itself, because it's actually like it struck the first deal with Google right now to read and ask the AI to actually machine to learn it. So at the end of the day, AI, the more information, the better information, the more deep dive into things that it gets, the better result it will generate. So it's a good thing that they have that vast 18, 19 years of treasure trove that it can actually use. But at the end of the day, it's kind of like Wikipedia. Sometimes you can't verify stuff, right? So it's up to.
But I would say also the big difference is that it's not, in the end of the day, a Chinese company, right?
No, this is true.
I mean, I appreciate TikTok is quote unquote domiciled in the U.S., but like if you thread the needle, it goes up to China.
Indeed, and this is the one issue that TikTok has been trying to convince investors of, convince U.S. politicians of, that no, we're based in the U.S., but it looks like nobody's bought that story, and here we are with this legislation going through Congress.
Yeah. And we've seen Shein as well. Shein was supposed to actually come this year to the U.S., and it's exploring other places for listing, like the U.K., just because of that Chinese connection. So, but then ARM also has like kind of a risk factor in China as well, but then it went through as well. So at the end of the day, like whether TikTok ByteDance will come,
we'll have to see. For Reddit, why do you think it decided now is the time?
Actually, a lot of the times where IPOs actually come to the market during this time when the market is not fully open, it's a certain kind of factors. Is whether it needs money for growth or it wants to actually give the venue for its employees to sell. And obviously, there are private share platforms that allow that to do that, but then it's not as liquid. And so at the end of the day, for this particular Reddit sale IPO, a third of it comes from its employees wanting to sell. So that is part of the driver for his IPO to come right now.
What is investor appetite generally now for the risk of an IPO? Because you said the market has been sort of coming back, but this is in the midst of a massive run-up in the S&P 500.
Exactly. So in terms of equity capital market, all the other channels are really fired up, like all the other two engines in terms of secondary share sales and also convertible bonds. They are just going through the roof. Last 2 weeks, it was more than 10 billion a week, which was amazing. And then in terms of convertible bonds, a week was, a third of last year's new issuance as well. So it was great. But then that has not transferred into the IPO, which is a riskier asset. So we have seen that the discount that investors were asking for IPOs is still at 20-25% discount to already listed peers versus 10 to 15% in the past. So that sentiment has not come back. People still want to have a bit of a cushion. And the fact that the first two big IPOs, Amer Sports and also BrightSpring, they weren't trading as well, it's still a concern lingering on a lot of investors' mind.
Amy, great stuff. Really great conversation. I learned so much in that. Thank you so much, Amy Orr, Bloomberg Equity Capital Markets reporter.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's flex the muscles. I know one person who has definitely seen the Oscars, and that's Geetha Ranganathan, Bloomberg Intelligence analyst for U.S. media. Have you,
You're
Geetha?
sure?
Actually, I don't know for sure.
Taped it.
I hope so.
Geetha, have you seen it? Did you see it?
I did. I did, Alex.
Hey! For the record, I have been trying to find one person on this radio show so far who has seen it, who can talk about I'm Just Ken with me, and I have struck out, which I feel like is part of the point. No one watched it with me except for my husband and my daughter.
Yeah, I mean, this has been the perennial question, Alex. I mean, about ratings, right? Is linear TV even relevant anymore? But you'll be surprised to know the Oscars actually are one of the most watched non-sports telecast on TV every year. And yes, ratings are down. So back about 20 years ago, it was about 40 million people tuning into, the Academy Awards ceremony. Now it's closer to about 20 million, but that's still a huge audience, kind of considering that the pay TV universe has also kind of shrunk by about 25%.
Okay, so what did you think of I'm Just Ken?
I thought it was brilliant. It might have been the most. Yeah, I thought.
Me too.
I just thought that was the most exciting part of the whole ceremony.
It was awesome, and they did a whole harken back to Marilyn Monroe, and then Madonna wearing pink, and Ryan Gosling in pink, and the guys in the back were wearing the same costume. You had to see it. You just had to see it. It was really awesome. Okay. Anyway, sorry, Jen. You can ask a real question.
Can I ask a real question? So, who are the winners and losers here in terms of old media versus upstart streamers? It looks like Disney did very well, Comcast did well. What's your take here?
Yeah, I'm really glad you asked that question. I think the one big surprise, and this is really good for old media, is that old media is back. Theaters are back. The theatrical experience is back. And, in a kind of this wild twist, streaming was kind of almost completely shut out. So going into the Oscars, we really had, the two big streaming, giants in a way. Netflix with 19 nominations. They only got one. You had Apple with Killers of the Flower Moon with 13 nominations. They got completely shut out. So, and then of course, you had the big sweep with Comcast Universal with Oppenheimer. So, in many ways, this was really a resounding success for the theatrical model and for the long established studios.
Also Disney, right? I mean, Poor Things.
Yes, Disney with Poor Things. Yeah, with
Poor
Searchlight.
Things
yes.
came out of nowhere in my world. I mean, I'm not the judge of everything or anything like that, but it seems like Poor Things really came out and stole a lot of awards that maybe we weren't necessarily expecting, which is a great win for Disney.
It absolutely was, and considering the budget, and everything that kind of went with it, it's Searchlight and the Fox acquisition from this studio point of view, from the point of view of critical acclaim. I mean, Disney has really done well with that acquisition because it's gotten them like a lot of critical accolades and some commercial success as well.
So I want to go back to your point that theatrical releases are back, old media is back. What kind of legs do you see on this trend? And I say this as a massive movie buff, but I have yet to really fully return to the cinema. I think the last one I saw was Mission Impossible, because it's just, there's a lot of hassle to go.
I mean, it's a fair point. I mean, yeah. I'm not that far from you either.
So it absolutely is.
Oh, yeah, so sorry. Yeah, so what's your take? Is the pandemic over? Is it all back? What's the story here?
It's been a bit of both a demand and a supply problem. So, what has happened now, we did see somewhat of a decent recovery, I would say, in 2023. We saw box office getting back to $9 billion, which is still not equal to pre-pandemic levels. We're still about 20% short. There's good news and bad news. The bad news is 2024 is not going to be better than 2023. And the reason is the Hollywood strikes. Both the actor strike as well as the writer strike kind of created a lot of holes now in the calendar. They pushed out a lot of the big releases that were originally slated for 2024 to 2025. That's going to shave off roughly $2 billion from the box office. So we're actually going to see 2024 come in much lighter than 2023. But the good news is that 2025 everybody's expecting it to kind of be this blockbuster year where we will see, box office kind of really get back, hopefully, to those pre-pandemic levels at about 10 billion or so. But I think generally the takeaway, Jen, was that, studios definitely want to make that commitment to theatrical, because back in the day, especially when COVID was rampant, I mean, there was this big question about whether we would, with everybody kind of doing the day and date at that point of time, there was this big question about whether everything was going to move to streaming. And I think that's definitely not the case.
If you didn't have a job as senior U.S. media analyst for Bloomberg Intelligence, would you have watched the Oscars?
I would have. I definitely would have. I've always watched it. Yeah.
Okay, good. All right. And I just want to get that clear. It's not just because it's your job. Okay, let's talk about the elephant in the room. And that elephant is very large in the form of Paramount Plus. Any updates on this? Any sort of insight? Any sort of what's next now that has maybe changed?
Nothing really has changed. So, we've had management kind of speak on multiple occasions. All that they've said is they're kind of evaluating all possible offers, which seem to be kind of dwindling, actually. We had, multiple rumors, I would say, swirling about a few weeks ago, but really nothing, Alix, at this point of time. The studio, of course, is still very much in play. We had some news about Paramount kind of disposing off some of their, or wanting to dispose off some of their non-core assets, their Indian operations, if you will. So they're definitely looking ready or getting ready for a sale. I just don't know when or how it's going to happen.
Now, can we go back to the streamers a little bit? Because there is a question that I wanted to ask you. I mean, we had Netflix upgraded by Oppenheimer today, or their target, the price target was raised at Oppenheimer today. And this is taking a look at trends in user growth. But, Netflix really raised their costs recently, and then that, they managed to survive that and subscriptions held up. How do you see that progressing over the course of the year, especially if we have a slower economy?
So I think at this point, Jen, Netflix has kind of really established itself as the dominant streaming platform. And I just say that because, kind of when you think about, you just go home every night and you think about, what do I want to watch? I mean, Netflix has kind of almost become this habit right now. And so people naturally kind of gravitate towards it. And so I think that gives them immense pricing power. So will they be able to raise prices in the future? Absolutely. Do they have more growth levers to pull? Absolutely. Advertising is still a very, very small business for them, but they're looking to make it bigger and bigger. We just, I don't know if you guys watched, there was this exhibition tennis match between Nadal and Alcaraz just a few days ago, and now they have this big fight that's coming up between Mike Tyson and Jake Paul. So they are doing more and more to get into kind of, live events. Obviously we know all of the WWE content, the Raw content is coming starting January 2025. So they're branching out into different things. And the whole idea there is to kind of add more content, more breadth, more depth to give them more pricing power. So yes, I absolutely think that, they can grow both subscriptions as well as revenue.
Really, yeah, I forgot about that Tyson fight. Also, are those things less expensive to make? I mean, I know you probably have to pay him a lot, but versus like a series?
Well, almost equal. It would be like
okay.
one of your big budget series, because I think they're paying about $300 million for the fight. So roughly equal to maybe like a big Stranger Things.
Okay, all right, fair enough. I was gonna say, oh, maybe the ROI on that is a little better, but maybe that's not true. What's your go-to, Jen, streamer?
Well, actually now, weirdly enough, it's Hulu.
Huh.
Yeah,
okay.
we're obsessed with The Rookie, and so I binge watched that whole thing, which is strange. But now we're watching Shogun, and we're really just taken to that.
What's Shogun?
Shogun is excellent.
The
it's
James
excellent.
Clavell novel. They've redone it.
Oh.
We just watched the first episode last night. It's very good.
Okay. No, but you're not doing that, Tucker. You're reading some kind of Siri books on thing about something.
You can't judge anything I'm just like.
What are you watching?
No, I'm not watching anything. I'm trying to finish a 1,200-page book with type about that big. So it's
what book? Tell us.
It's been on my shelf for 30 years, literally. I kid you not. And I finally I never read this. I got to pick it up. The Power Broker.
Oh my
Robert
goodness.
Caro. And it's just like, it won the Pulitzer Prize back in the 70s. And it's just, what a tour de force. It's just like, and if you're a New Yorker, it is your duty to read this book.
Okay, all right.
I don't care if it's 1,200 pages. You have to do it.
We saw the play that Ralph Fiennes was in. It was fantastic.
Oh, really?
Yeah.
No,
I mean, it's Ralph Fiennes, so that makes sense. No, I'm reading all the Reacher books. It's like candy. I can just read like one an hour on the train.
Well, that's beach reading.
It's perfect. It's Alix everyday reading. All right, Geetha, thanks a lot. Geetha Ranganathan of Bloomberg Intelligence, a senior U.S. media analyst, and thank you for watching the Oscars, and thank you for saying I Am Just Ken is brilliant, because it was, and everyone should go and watch it, particularly John Tucker. Once
what
he's
do you
done
mean?
with
It's
the show.
over. How am I going to watch it?
It's called Internet. All right, this is Bloomberg.
Yeah. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, talking about CPI for tomorrow, we got the New York Fed inflation expectations coming in for 1 year unchanged, right? But for the 3 year, they rose to 2.7%. For the 5 year, rose to 2.9%. So let's get the setup then for tomorrow. Adam Coons is Chief Portfolio Manager, Winthrop Capital Management. He joins us from Indianapolis, Indiana. Were you up late watching the Oscars?
I was up late, but not because of that. Got 2 kids. They didn't want to fall asleep.
Oh, okay, fair enough. So no Oscars for you, just to be clear.
No. Mm-hmm.
Man, I'm really batting
You're really,
here.
you're striking out today.
This is tough. We should do the whole theme for the whole week this way and just like really get a good read on who watches what. All right, Adam, in the market, CPI tomorrow. Are we selling a little bit in the front end because of that? Is that what we're seeing?
A little bit, yeah. I think, unfortunately, we've gotten to this place where the inflation prints and anything that's going to affect the Fed is the primary driver of markets. So I think we're going to continue to see that through the rest of 2024. Expectations here really, right at 3.8. I think we're going to actually see this come in a little bit below that. I think there's going to be a surprise out of the service sector. We have already seen used car prices start to fall off as well, so that will play a role. So we're actually thinking we'll see a slight undertick from the expectations right now on both core and non-core CPI.
If the print comes in as you expect, a little bit of an undertick, how are markets positioned relative to that? Is there going to be a setup for some serious damage?
Well, I think it depends on how you're playing it. I do think you'll start to see interest rates on the short end come down significantly. But yeah, I think when we're talking about equity markets, that would be a sign that things are slowing down. I think a lot of people are kind of overlooking the impact that the slowdown in China is going to have on not just inflation, but just overall kind of consumption demand globally. So that's really what we think is going to drive this downtick, because this is just going to start to snowball. Like I said, as you see these big economies, demand is notably slowing down. U.S. has been resilient, but it can't outlive this forever.
So you think then that we won't get a solid rotation to other assets that will help prop up the market? That doesn't seem to be where you're at.
No, I don't. I think what you'll start to see is, as this kind of fear starts to pick up, obviously there was a lot of fear last year that just didn't materialize. And so some complacency moved back into the market. But if we start to see that shift in any direction towards back towards the fear, I think what you'll see is just more of a risk off, and you'll just kind of start to see, the treasury market will rally, but everything else I think will have a tough road ahead of it.
So what do you think then about overall corporate valuations? Are we in bubble territory then if, there's this expectation for a little bit of a softness?
No, I don't. I mean, I think our valuation's high, yes. But I think largely that can be offset by margin expansion. I think that's going to push us through this cycle, make it, this cycle at least, the business cycle I'm referring to, slightly more extended than what we've been used to. And that's why we don't think there's really going to be any significant softening or a recession in 2024. It might see something in 2025. I think it really just depends on Fed policy and how tight they keep things and how long they do that. But no, I think right now valuations are, and for the most part, fairly valued. There's absolutely stocks that you could consider bubble territory, but markets as a whole, no, not at all.
Okay, so in the scenario that you're laying out, what happens to the dollar? Like, you might have treasuries rally, but what does the dollar do in that scenario?
Honestly, that's a tough one because, it's a relative game. And at the same time, as maybe the Fed is forced to start to loosen their policy, everywhere else in the world is going to be way looser and have a head start on us. You're already, starting to see where China is going to have to produce some significant stimulus measures in order to prop up that economy. Europe is really no different at this point. So I think on a relative basis, I think the U.S. dollar remains fairly strong, which I think will make it difficult to invest in emerging markets as a whole, and could weigh down other countries. So I do think the U.S. dollar maintains its strength. It might weaken slightly, but by no means do I see it falling off a cliff like we've seen in past recessions.
So where does this leave the progress for Fed rate cuts?
Well, obviously the market's expectation has changed significantly as this year, just in 3 months, has come along. For it was pricing in 6 cuts to begin with, and now we're well below that, approaching 3 to 2. From our standpoint, we do think the Fed's going to be a lot slower to react through this monetary cycle. When you look at how they entered this with very slow changes into increasing interest rates using the transitory narrative for far too long, I think they're going to do the same thing on the back end, is that they're going to hold tight here and really wait to decrease interest rates until there are some serious cracks in the economy that they can point to, and all their data set, both hard and soft. Right now, I think that the rhetoric is that there's this idea that the economy is softening, but there's just not enough data to get the Fed to actually act. And so until you see those data points really screaming that the economy is slowing down, I just don't think the Fed's going to cut. And I don't know if they cut at all in 2024. Oh,
okay. So joining the Torsten Slog Apollo camp, that maybe no cuts, which de facto, that would kind of be a hike in essence. What would that do, you think, to the economy?
Well, I think honestly, if they don't cut at all this year and they keep things tight for longer, I think that is gonna that could lead us into a harsh disinflationary period where they overshoot the 2% inflation target, and suddenly we're wondering what happens if we're seeing Japanese style deflation. I think that's a low probability, but if they stay too tight for too long, that is the increasing probability of events, that it's a harsher thing for the economy to deal with deflation than some slight inflation.
All right, thanks a lot. Really appreciate it, Adam Coons, Chief Portfolio Manager at Winthrop Capital Management. That's super interesting if they have to wait, and the idea is the longer you wait to cut, then the worse the circumstance will wind up being.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.